Hi, welcome to ACI Process Portfolio's 2016 stock market outlook for Q1, and that's a little bit disingenuous. It's actually the outlook for at least the first half of the year and probably beyond. And what I'm going to do in this report is take a kind of a deep dive into what's been happening recently, look at some of the factors underneath that are driving some of the market behavior, and ask some questions about that, and hopefully also provide you some of those answers. For those of you that don't know, my name is Dak Hartsock. I am the Chief Market Strategist and Director of Investment for ACI Wealth Advisors and Process Portfolios. I'm a nationally recognized financial expert and an award-winning portfolio manager, and you can learn more about me by visiting dakhartsock.com/about. Now, this is a long video, much longer than any I've produced before, but like the others, I front-loaded it for my busier readers and busier clients that just kind of want to get my opinion on what's happening and don't necessarily want to stick around to see why I think what I do. For those that do want to do that, I've got a lot of data we can go through to help you understand what's actually going on. And if you do have some fears about what's happening, you're going to see, at least in our view and based on the data we're seeing, those fears may be misplaced at this point. So let's go ahead and hop into it. Here comes the executive summary. Are we falling into a major bear market, or is this just a sharp correction? And I'll let the cat out of the bag in my view. At this point, this is just a sharp correction. We do have a rising possibility of recession, but there's no confirmed signs of that as yet. That is subject to change. If those of you that read my articles and follow these videos know, but at this point, we're not seeing it, and I'll get into that a little more later. Falling oil prices are a positive for the economy, but there is a lag, and we'll talk a bit more in depth about that. But a lot of the fears about falling oil that seem to be in the media are misplaced or misinformed, and I'll show you why. Falling oil prices are not due to failing demand in either the U.S. or the world, and the question that people have is falling oil prices as a result of failing demand are usually indicative of a recession, either one that's imminent or one you're already in. We are not seeing that, and I'll show you why. Demand is not actually falling, so the pundits and talking heads have it wrong. Oil and gas credit market contamination should be limited, and it should be insufficient to tip the U.S. into recession. And what credit market contamination means, if it doesn't sound like English to some of you, all that really means is oil and gas companies borrow money in order to finance exploration and production. So, they need money to go out and find oil reserves. They need money to then get those reserves out of the ground and get it to market. And when they do that, it's called borrowing, and they refer to loans and bonds and things like that as the credit market. So there's some questions right now about whether or not falling oil is going to spread contamination through the credit markets, maybe like happened in 2008 with housing. And the answer to that is, in my opinion, and according to the data that we're able to see, the answer is no, and I'll get into that shortly. The global economy is stable despite the media hype, and the risks in China are smaller than actually perceived as we see them, and I'll talk a little bit about that in a few more minutes. The economy's solid away from energy, and we've also got some currency headwinds that have impacted the economy and earnings. And just to kind of really help you understand what that means, the S&P earnings last quarter actually were positive despite currency headwinds. If you take energy out, so we eked out about a 0.5% gain in S&P earnings if you exclude energy, and that's with some pretty significant currency headwinds. I'll talk a little bit more about that in a few slides. But the real question to ask about this is what happens when energy stabilizes, and it will, and what happens when currency stabilizes, when the dollar stops getting stronger, or when it maybe even pulls back a little bit. I'm not so sure that that's going to happen in the short term, but you do need to be aware of the question, because it could happen, and depending on what happens elsewhere in the global economy, it actually might happen. So that would be good for the U.S. U.S. equities currently offer some good investment opportunities. You've got average value in most areas. A couple places are maybe a little bit pricey still compared to their historical average, but you also have several sectors that represent very strong value. So I'm going to talk a little bit about that. The equity risk premium also suggests that stocks should be worth at least 3% more than bonds on an extended time horizon. I'll talk a little bit more about the equity risk premium, and explain what that is later on. But essentially, it's just, all things being equal, equity should produce 3%, and depending on how you calculate it, it could be 4.5% more than bonds over an extended time period. And history's, kind of on the side of this calculation. An easier way to think about it maybe is if you look at the S&P dividend, it's currently higher than the 10-year Treasury yield. So, growth is free. I'll talk about that a little more in depth and expand on that idea towards the end of the presentation. So let's hop into it now for the executives that are just willing to take my opinion on this or my conclusions. You could skip ahead to, I think, the 13th slide to get the actual conclusions, but if you don't need to see the data underlying the bullet points I just went through, then thanks very much for attending, and see you next time. For the rest of you, I got some more information here that might help you feel a little bit better about what's happening. First off, here's the recession probability indicator, and I'm presented it a little bit differently than I have in the past because I think it's important to show, visually what it does. So these gray areas here are recessions. And what we see is in 2001, and this actually indicator goes back, I've tested it back over 30 years, and it's pretty consistent. It's going to catch this the vast majority of the time. So what we see is, we're catching a recession signal well before we actually hit the recession. And then in the 2008 crash, here's the first signal. We're actually already in recession, but then it confirms about a month later. And this would have helped you reduce risk when the S&P was only down about 15% from its peak. So, it's a pretty good tool to have. And we've had some spikes previously, but for the most part, you can see in between recessions, the investing environment is generally favorable. And what that means is it's a good time to be invested, all things being equal. And the RPI, recession probability indicator, most of the time just kind of bangs around between about 3 and 17, and that's really where about we are now. So seeing nothing in the RPI, at least yet, that says that we've got a recession coming, again, subject to change. Okay, time to talk a little bit about oil. So what we've got here is a graph. Now, oil is inverted versus GDP and personal consumption spending. But what we've got here is when oil goes up this way, it's becoming less expensive. When oil goes down this way, it's becoming more expensive. And GDP is the yellow line, that's gross domestic product, and red is basically personal spending. So what you see is when oil falls within about a year, you see GDP begin to increase, you see personal spending begin to increase. And that's pretty much played out for quite some time. This thing goes all the way back to the mid-80s. So you can basically see when oil gets cheaper, personal spending and GDP have a tendency to follow. So the issue, though, is that there's a one-year lag. And so that's something that you got to be aware of. But according to an analysis by Bank of America, for every $10 off a barrel of oil on an annualized basis, it can add as much as 0.25% to GDP. And whether that plays out or not is anyone's guess. If history is a good guide, then we should see some form of that. And if so, 2016 may see a GDP increase as a result of lower oil prices that could be 0.5%, maybe a little bit more. And what's being anticipated for oil prices in 2016 by most analysts is about $40 a barrel. Who knows if they're right or not, but the point is oil in 2014 was about 85 a barrel on average. In 2015 it was about 45 or 50, and in 2016 it's anticipated to be around 40. So if history holds out, then we're about to see at some point this year in 2016 a tailwind emerge in both GDP and personal spending due to low oil prices. And a lot of guys have said, well, it's not materializing like in 2015. Well, the fall in oil, we're not seeing any benefit from it in consumer spending or GDP. It's because it takes a year. So we'll see what happens, but most likely this is going to emerge as a tailwind in 2016, and if prices stay low, we should really probably see something substantial in terms of tailwind for 2017. Moving on. Pundits say the world is buying less oil due to rapidly slowing economies. And what we see here is that this is really an oversupply issue, plain and simple. Here we see a recession. Okay, so this is the demand line for oil, and it's pretty consistently up as the world grows, in terms of people and industrial capability and so on. But here's a recession, so it's dipping. Here is demand as of December 2015. There's no dip there. So the issue with falling oil prices has nothing to do at this point with falling demand and everything to do with oversupply. And for those of you that have been around for a while, the cure for low oil prices is low oil prices. It's that simple. So we already see this happening. The U.S. Department of Energy does a survey of active rig counts. That means how many oil rigs are actually, producing. And in early 2015, there were about 1,700 active rigs in the United States. And as we enter 2016, as of January, there's about 500 producing rigs. Each oil rig has a tendency to see its production drop off by about 5% annually. So, in other words, a rig that produced 100 barrels last year is probably going to produce 95 barrels this year. So, at least domestically in the United States, we're going to see supply really correct itself over the next year or so, maybe 2 years. I'm not sure it'll take that long. But enjoy low oil prices while you can. They're going to be around for a while, but this is not a permanent condition. So, something to be aware of. Let's move ahead. Okay, so market contagion. What this means is there seems to be a concern out there that, and this is the reason the market has been following oil down, right? So when you see oil drops 4%, you see that the markets, at least the last couple of months, are also down that day. Well, why? Why is that happening, right? Oil's not the markets. The question that's being asked and that people are fearful of is, can the oil company defaults on the loans that they owe the banks bring back 2008? Can they destabilize the big banks? Can they kick out the underpinnings of the financial system and create a domino effect where everybody's going to have some pain? So let's talk about that. Here's some points. First off, banks are much better capitalized than 2008. And in the 2008 housing crisis, the total assets of the banking system were about 10 trillion. And subprime exposure about 1.3 trillion. Well, let's look at what we've got here in 2016. Distressed energy bonds, we've got a banking system that's 30% larger, more than that, versus 2008. We have maybe 180 billion in distressed energy loans, according to Standard & Poor's. Maybe it's a few billion higher, maybe a few billion lower. I don't know, but the point is it's nowhere near the same scale, in terms of the total exposure. Standard & Poor's is also saying, maybe 50% of that 180 billion or so is at serious default risk. So I think you can probably see that it's really not a real comparison between the risks associated with the two. I'm not going to get into the commercial paper risks, the things like credit default swaps and stuff like that. There's some of that going on with oil, but it's not nearly the scale that it was in housing when, insurance companies and banks and teachers' pension unions and, everybody owned mortgage-backed securities and credit default swaps and this, that, the other. I mean, that was part of the problem. There's been a lot of regulation put into place, particularly with credit default swaps, to make that kind of a hard row to hoe right now, or a difficult comparison to make, because those markets for distressed energy bonds are just not nearly as big as they were for housing. So let's put this in perspective. What does that actually mean? Wells Fargo has the largest energy exposure among U.S. banks at this point. And again, let's kind of frame that. Wells has a loan book, including all loans, of approximately $925 billion at the close of last quarter. About $17 billion of that looks like it's energy loans. So that means 2% of Wells Fargo's entire loan book is in energy loans, right? So let's pretend that half of it goes bad. Okay, so $8.5 billion never gets paid. What is that going to do to Wells Fargo? They make about $20 billion a year net. So if those loans go bad, all they have to do is take their earnings for a couple of quarters and pay it off. They write it down. It's not going to collapse Wells Fargo. It's not going to, knock them down and then take down other big banks that are, the support and the structure of the financial system. That's not to say that there aren't regional banks that may have a little bit rougher time with this, that maybe loaned out a bigger percentage of their loan book to oil companies. We might have some regional bank difficulties. We might have some regional bank failures. But those are not enough to push the U.S. into recession. They're not enough to recreate 2008, where the entire financial system is at risk. So I'd like to add another thought to this about the impact of the difficulties in energy right now. Energy capital expenditures, and that's the money to some extent that they borrow to spend on finding new oil and developing it and getting it to market, it's only about 4% of total U.S. capital expenditures. So that reflects less than 1% of GDP. So let's just say all of energy capital expenditures goes away because nobody in the energy sector has any money to finance any capital expenditures, new projects, anything else. It could maybe shave a couple of tenths off gross domestic product, but most likely what's going to happen is that that loss is going to be made up for with the savings to the consumer, which should begin to hit in 2016. JP Morgan Chase has said that Americans are going to spend about 80% of their fuel savings on, whatever, discretionary spending or so on and so forth. So if you look at it, Americans saved between 64 and 90 billion, depending on how you want to calculate it, in 2015 on fuel costs. So over the next 12 months, we can anticipate somewhere between 51 and 70 billion in extra spending as a result of low oil, as consumer spending finally catches up with the savings that they realized in 2015. So that's a pretty big chunk of, half of this money going bad. The 180 billion, if we've got 90 billion in bad loans, well, this is getting close. And that's before you even factor in the lower cost inputs for corporate consumers. And again, for those of you that doesn't really make a lot of sense of, or sense to, just take a look around. Everything you see has plastics in it or some type of petroleum derivative. So the companies that make things like computers, TVs, radios, keyboards, tires, cars, engines, paint, you name it, when oil drops, their cost of input, the raw materials they need to make their product, drops along with it. So that's savings for them, which is going to most likely increase their margins and profitability as this drop in oil catches up with, the spending cycle in GDP. So, the end of that argument is most likely, even if we do see a bunch of these defaults, even if we see 50% of these defaults, it will probably be more than compensated for by consumer activity and by reductions in the materials costs of the producers of goods that are part of our economy. And therefore, it should be a tailwind moving into 2016, certainly by 2017, if oil stays as low as it has been for the last several months. So, okay, let's talk a bit about the global economy. You may have heard, people talking about how the global economy is in trouble and we're moving towards recession and so on and so forth. Here's the thing: is first let me explain this chart. The red is emerging markets. The lower blue line is developed economies. That's advanced economies. That's the U.S. and Europe. And then the gray line is the combined world. So what we've seen is we've got some softness in emerging markets. That's because commodities have been falling. Globally, there's a little bit of softness, but advancing economies are still doing okay. We're actually advancing, and according to the IMF at least, we're all due a turn up, and some of this is lower input prices because of oil and increased consumer spending and so on. But the point of it is the world's relatively healthy. And you may have seen the line where some giant guy, I think it was Soros, came out and said that we're going to see 2008 again. Well, he was talking about China. He wasn't talking about the United States. And somehow that got lost in the context. So let's just say, well, what if China does have a 2008? Is that actually possible? China looks like it may have overextended investment in housing and manufacturing investment, but China is not the same animal as the United States in 2008. The Chinese government is authoritarian, and they can and will do anything they want. In the United States, there's a chance that the Fed could run out of bullets in order to prevent a recession, but they're not going to do that in China because they can actually use bullets. And the point of that is the guys that run their economy, if they crash it, they're going to die, or somebody's going to die, or they're going to go to prison for life. There's none of this softness that you see in the U.S. So they are heavily incented to make sure that these things don't happen. And they also had the example of the U.S. to help them understand how to best react to it. So they're going to make sure they do everything they can to avoid that. And that's kind of a sidelight because the crash itself, the U.S. credit crash, was primarily a result of fearful banks refusing to lend on anything they felt might not be 100% safe. And the reason the Fed dropped interest rates and started buying treasury bonds was to make sure banks couldn't make money by parking their cash in treasuries, which U.S. treasuries are basically the safest bond or safest investment in the world. But by making them pay so little to put your money into it, the banks couldn't make money. So they had to go out, at least this was the Fed's idea, so the banks are going to have to take their money and start lending it. So they were incenting the banks to lend money. The Chinese banks don't have the luxury of choice. If the Chinese government says you're going to lend money, the Chinese banks are going to lend money. They're state controlled. They're not like American banks. They're not like European banks. So this is not 2008. Whatever problems China has, they're going to get managed one way or the other because they have no limits to what they can do. They have no hands tied in the Chinese government. They can literally do anything they want to do in order to protect their economy and protect their markets, unlike the governments in the West. And there's a price for that. Like, you can get shot, but in terms of 2008 redo, I just don't see it. There's always a chance that I'm wrong, but I don't buy it. And China is going to see some slowdown, and that's kind of something that they know about. It's something that we know about because they're transitioning from a manufacturing and investment-based economy to a more service-driven economy like ours. And that's good for them, that's good for the world, but it's going to take time, and over the course of that, you're going to see their economy slow, but that doesn't mean we're seeing 2008 again. So personally, I think Soros probably had a short position somewhere, and he needed to scare the crap out of people in order to make money on it, and he's allowed to do that. So let's see, move on. A little too much time on that. The U.S. economy. It's pretty healthy. This is a chart from the Fed database. I get a lot of information from this, and what we're looking at here is non-manufacturing business activity in the United States. About 80% of U.S. economic output is in the service sector, so it's non-manufacturing. This is it. When you look at this number here, 50, that is kind of where you draw the line. So when this falls below 50, we're clearly in contraction. When it's above 50, we're in expansion. As you can see over here, I think the most recent number was 57 or 58. We are clearly in expansion. 80% of our economy is clearly in expansion. So that's a positive. That's something that we don't have to fear or worry about at this point. So what is maybe of a little more concern? You've probably heard manufacturing is actually in recession. Well, that's somewhat true, but you need to understand what's driving that because it's not what you probably expect. What's happening is there's two things to keep in mind here when you're looking at manufacturing activity, and you can see it's dropped below 50 here, right? So that signals contraction in manufacturing. Manufacturing fell below 50 about the same time that the dollar began to strengthen seriously in the last couple of months, and it actually moved up about 3% in late October. And it's no accident that November marked the point that the ISM, this PMI composite index, fell down below the 50 point, which signals mild contraction. And you also see a slight downtick from there in December. It's the same thing. The dollar got just a little bit stronger from early December to the end of December. So, let's think about what this means. When the dollar gets strong, it means that American products are less attractive overseas to overseas buyers, and it also means that importing stuff from other countries is less expensive sometimes than the stuff we make ourselves. So, when you're looking at this number, understand this is more a reflection of currency headwinds than it is an actual recessionary risk at this point. So, what happens when the dollar stabilizes or maybe begins to weaken just a little bit, which it may do, no telling what the time frame is. It could be a week, it could be a month, it could be 5 years, I don't know, but the point is it will happen at some point. I think it's probably sooner rather than later. And if so, then you can see that this really isn't going to be a demand weakness issue as a result of a recession coming. It's just temporary transient demand weakness due to currency headwinds. Um, and those might be transient. So, there's my opinion on that. And keep in mind, this is a much larger segment. Our most of our economy is driven by, the non-manufacturing business activity, and we're doing very well there. So let's talk about pockets of value. There's several sectors that are in this situation. I'm going to kind of get a little in depth here so you can understand the rationale behind it. What we've got here is a technology sector. The red line here is the average price earnings ratio. For those of you that maybe aren't clear what that means, maybe go to Wiki Invest or something, but generally a price earnings ratio is the most widespread way of understanding if you're paying too much or too little, or a perfect price for a security that you buy, and it's a relationship between the actual price you pay and the earnings of that security. So, what we're seeing here is that the tech sector is about 15% below its average price earnings ratio for the last 10 years. And, I'm not saying that this is exactly right. I just took the average for the purposes of comparison. So, what you see is if you compare it with its long-term price earnings ratio, it's undervalued, right, versus history. So if you also then look at the earnings growth estimates for this sector and historical earnings growth, they're kind of range between 8, 9, 10, 12%. Some are a little bit even higher. But if we just pretend that it's 9% earnings growth for the next 3 years, and it's never valued at a higher price earnings ratio than it is right now, you're still going to see about 26% higher price in this sector in 3 years. That's not a guarantee. Obviously the market does what the market does, but that's kind of how you think about it. And that will happen most likely barring recession. If it does happen to rise up to its average value for the price to earnings, then the price would have to move up about 40% over that 3-year period. Now, I'm not saying that's going to happen, but stocks have a tendency and investments have a tendency to do what's called reversion to the mean. And this is a kind of a simplified way of looking at that. So what's the easy rule of thumb is if, for example, it's down here, that's probably not a bad time to buy, because if the earnings are stable, you might have some upside if you get what's called a price to earnings expansion. If you're all the way up here, then you need earnings to grow even stronger than maybe they have historically, or you may see what's called a price to earnings contraction. Pardon me. So anyway, what this says is that down here you have a much lower margin of risk than up here. So all things being equal elsewhere in the economy and so on, this is not a bad place to buy. It's a better place to buy than here, that's for sure. So that's kind of the way to think about it. But the point here is there is value in the market if you know how to look and where to look. And there's actually several other sectors out there that have already entered a bear market and may represent some pretty attractive intermediate and long-term investment opportunities. And by the way, I'm not advocating anybody to go out and buy technology. I'm not giving individual advice here. I just picked this as a generic example of some of the things that are available out in equities. This may or may not be a suitable investment for you, but that's not the point of this. It's to get you thinking and understanding what's actually happening beneath all this volatility. Let's step up here. What we're seeing here is the difference between the 10-year Treasury yield over the last 25 years or so and the dividend yield on the S&P. And what we see is the S&P dividend yield generally is below the bond yield, and that's the argument for owning bonds, right? Because they're safe and you can actually get a guaranteed return. Well, right now that guaranteed return is pretty low. And from the standpoint of an investment advisor, if I had 10 years to park money, all things being equal, and I get 2% for buying the Treasury, or I get a little more than 2% for buying the S&P, and I've got a 10-year time horizon, do I think the S&P is going to be higher in 10 years? From my position, yes, I do. So therefore, I would put that money into the S&P. Again, not individualized advice. I'm just giving the example. But what you get there is you're probably going to wind up getting about that same 2% as if you had locked in your bond for 10 years, which you can't sell if you want to make sure you get your principal back. But you can collect that 2% the whole time. Pretty good chance I'm going to collect 2% on that S&P. Plus, if the S&P is higher at the end of this time period, then that's a huge bonus. What if the S&P is 20% higher, 30% higher? Pardon me. That's what I mean when I say capital growth is free right now. So, and this is not likely a scenario that's going to last. Okay, so conclusions. I'm of the feeling that panicky sellers are probably missing the boat, barring a recession, which we don't see yet. If we do experience a bear market without a recession, which we've got in some sectors right now, history strongly suggests it's going to be a very short duration and pretty shallow. And like I said, some sectors are already in that bear market kind of framework and could represent some pretty good intermediate to long-term investment opportunities. I'm expecting 2016 we're going to start seeing some of the benefits from oil prices being as low as they were in late 2014, 2015. And this could be a pretty positive catalyst for the second half of the year. I don't see oil prices firming up drastically between now and the summer driving season. So, and maybe not before the end of the year, but at some point, 2017, 2018, we're going to start to see oil move back up, I think. The biggest risk to the economy and therefore the market at this point is the Fed. And one of the Fed heads, whose name I've forgotten, probably should mention anyway because I consider him a moron, he came out and said that the Fed is going to raise 25 basis points each and every quarter in 2016. And as soon as he said that, the markets really started to get a little crazy. And I'm sure right now he's been told to keep his mouth shut because there wasn't anything like that in the last statement, that said the Fed is hell-bent for letter to raise 25 basis points every quarter. But as a side note, if they do, the economy can probably withstand it. Most likely will withstand it. But I don't see it happening. I don't think we're going to see more than 37 and a half basis points in additional raises this year. For those that don't know what basis points is, that's a fraction of a percent. So 37 basis points would be 0.37% on top of whatever the bond raise is. I think contrary to what this guy said, if we did all of those raises, we'd finish 2016 at 1.25% at the Fed rate, funds rate. We're more likely to see 0% than 1.25%. That's my opinion. So last kind of thoughts, the presidential election and the legislative seats that are up for grabs, I'm not really sure what kind of impact that's going to have at this point. I put some thought into it, and pardon me. I think if we get a Republican in the White House and a supermajority in the legislative bodies, I kind of think that move could be cheered by the markets. I think that might be well received. If it's Trump, he's kind of a little bit of a cowboy, a bit of a wild card, and so there's going to be some unknowns. And the market doesn't really like those uncertainties, so that might not be the best thing, but I don't see that as a giant negative for the markets. If on the other hand, we have a continuing expansion of government control because the Democrats win both the House and the Senate back and get majorities there, and they also keep the administration. I'm not sure that's going to be seen as a positive by the markets, but I could be wrong. I'm not saying, I'm not taking a political stance here, just kind of giving what I see as a potential outcome in the markets based on what might happen. The only thing I can say with unequivocation is that the spending that's going to come out of the campaigns is a net positive for the markets and for the economy. So, there might be a little bit of extra GDP hit there or a spending hit that comes from all of that spending, but at this point it's not too certain. Overall, in conclusion, we're in a pretty good time, not the best time, not the worst time, but a decent time to put money to work in the markets if you're investing for more than, next week or 6 weeks from now or 6 months. If you're investing over an intermediate to long term, this is not a bad place to get money to work. And in fact, we're going to be getting some of the extra cash we've got floating around to work over the next few days and weeks. So thank you. If you've toughed it out this far, I hope it's been informative. If you have any additional questions, if you're a client, feel free to give me a call at the office, or if you're just a subscriber or a reader, you can reach out to me via email, or of course use the contact page on the site. And other than that, thanks very much. I hope this has been a good use of your time, and I will talk to you again soon.